I am Peter Joubert from Imali Pro. We specialize in Forex trading, intermarket analysis and money flow. There are two risks in trading: risk of the trade itself and the financial risk we take in opening a new position. The risk of the trade is the most difficult to assess. A key success factor for a Forex trader is to assess and quantify the risk you are taking in opening a new position. Is the trade high risk, medium risk or low risk? You must be able to do this yourself. According to Coulling, there are three distinct approaches: relational, fundamental and technical. Every decision taken by an investor, trader or speculator is only about money. The problem of currency traders is that they fixate on one currency chart and its movement, for example, the euro-US dollar. Market prices are the result of the combined decision-making by investors and speculators across all markets with two objectives in mind: either to increase their wealth or to protect what they have. When a market participant buys a high-risk asset class, for example stocks, they are relinquishing liquidity. In other words, they're spending their money in return for some future gain and is prepared to take on higher risk. On the other hand, when a participant sells high-risk asset classes, they are looking for a safe haven to protect their gain and will so buy the low-risk asset class, for example bonds. When risk appetite returns, traders will buy high-risk assets again. This is a cyclical process that all markets follow minute by minute and day by day as money flows from high risk to low risk assets and back again with the aim to maximize return. The market sentiment is about the readiness of investors or traders to take risk. When we're talking about market sentiment in case of Forex trading, we're making a distinction between risk aversion and risk appetite. These terms relate to the state of mind of investors. Sentiment is an important cause of trader behavior. Every asset class in the financial markets has a different risk profile, and as a result, market sentiment and risk appetite change continually. Risk aversion has to do with fear and global economic uncertainty. In the instance of risk aversion, investors will distance themselves from risky investments such as currencies with high interest rates, commodities and stocks. They will rather prefer to invest in the so-called safe investments such as safe haven assets like the Japanese yen and bonds. Risk appetite relates to greediness and the favorable global economy. During a period of risk appetite, investors will choose the riskier investments like stocks, commodities and currencies with high interest rates. It is now time to analyze the four principal capital markets: bonds, commodities, equities and currencies. We must know the risk profile of each capital market and how we can use that to quantify risk and market sentiment. Bonds are generally considered to be a safe haven assets. Bonds are the basic ingredient of the world's debt capital markets. The bond market is double the size of the currency exchange market at approximately $100 trillion. This market is mostly ignored by Forex traders because they perceive it as irrelevant and difficult to understand. The bond market gives you signals about risk, money flow and market sentiment. Bonds are easy to understand. A bond is a loan. The market allows various bodies, for example countries, governments, municipalities and private companies, to borrow money for many reasons. Coulling has a good bond example. Suppose you need money for a new business venture and you have a friend who will lend you the money. He offered to lend you the money at 5% interest per annum on the life of the loan, which you agreed is 10 years. Your friend believes this is a low-risk guaranteed return. Let us convert this into bond language now. We issued a bond, often referred to as a note, of which $10,000 is called a coupon, and the length of the loan is the bond's maturity, which is 10 years. We sold a 10-year bond with a coupon of $10,000. Your friend bought the bond and lent you the money for the business venture. We asked the question: Why do people buy and sell bonds, and what do they tell us about money flow? This leads to risk exposure. Bonds are generally perceived as a low-risk investment, so the money flow into bonds and away from other markets when investors and speculators are nervous and looking for a safe haven for their money. In general, bonds are low-risk asset class which usually sees inflows of money when markets are nervous. Bonds are a barometer of interest rates, inflation, public sector debt and economic growth, which are key measures of money flow and currency exchange. We use yield to analyze this huge market to help us in our trading. This measure gives us clues and signals of market sentiment, risk appetite and so money flow. Yield tells us whether the market is buying or selling bonds and whether the yield is so rising or falling. When confidence is high, the 10-year bonds price drops and yields go higher because investors feel they can find higher returning investments and do not feel they need to play it safe. But when confidence is low, the price goes up as there is more demand for this safe investments and yield fall. Bonds are generally considered to be very safe, but some bonds are safer than others. Some governments struggle with debt problems. Treasury bonds have maturities of more than 10 years. This is the benchmark bond we will use when considering bond yields and what they can tell us as Forex traders. Like bonds, commodities are generally ignored by the majority of Forex traders, but for different reasons. Traders ignore commodities because they regard them as irrelevant. This is a big mistake by traders. The relationship between bonds and commodities is one of the pivotal relationships in this market. Bonds are about money and the cost of money. The commodity markets are where we exchange money for real goods. For example, a power cable manufacturing company buying copper and aluminium to manufacture power cables. The commodity markets play central roles of converting money into raw materials. This gives us an insight into the fundamentals of world economics. This relationship is the bridge between the speculative world of paper-based assets and the tangible world of goods. This is a real situation where prices are determined by supply and demand across the world. Gold plays a unique role in the commodity sector. People use gold for jewelry, coins, industrial purposes, and investing. Several factors play a role in the price of gold. Gold is the ultimate safe haven hard asset and hedge against inflation. Commodity markets provide the real-world bridge between money and goods. Commodities also provide a bridge between individual currencies and commodities. A commodity-based economy, such as Australia, will sell its raw assets, for example gold, internationally in return for a hard currency. This will again reflect in the currency itself. The higher the price of gold, the more likely we will have a strong Australian dollar against other currencies. An economy lacking in base commodities will need to import to maintain economic growth. Japan is a good example that has to import almost all base commodities such as oil, gas and the metals. The CAD-yen currency correlates closely with crude oil. The relationship of the US dollar and commodities is pivotal. The prices for most commodities are expressed in US dollar. It is a fact that when the value of a currency falls, then internationally traded commodities become more expensive when buyers with a weaker currency have to pay for it. Most traders are familiar with equities, but only a few analyze equities to determine the signals that this market conveys. Also known as stocks or shares, equities represent a share of ownership in a company that you can buy. Equities are the riskiest asset class because share prices are subject to large movements in the stock market on a daily basis, so that as an investor you can experience large gains or losses. Just like bonds and commodities, equities tell us a great deal about risk appetite and market sentiment. There is a strong relationship between equities and bonds. Equities are viewed as high risk, offering higher returns, whilst bonds are considered to be low risk, with conservative returns. As a result, there is a continuous flow of money between these two markets, with the resulting flow both in and out of particular currencies and currency pairs. Equity markets provide us with a barometer of market sentiment, which in turn is reflected in the broader economy and associated markets such as commodities. Equities reflect how well all listed companies are doing. If investors are confident, they will buy stocks. The stock market contributes to the nation's economy. Stocks assess how valuable investors think a company is. When stock prices rise, it means investors believe earnings will improve. Falling stock prices mean investors have lost confidence in a company's ability to increase its profit margins. Lower stock prices mean less wealth for businesses, pension funds, and individual investors. Despite its critical role in the economy, the stock market is not the same as the economy. The stock market is driven by emotions of investors. The last of our four capital markets is the Forex or currency market. This is unique for many reasons. The currency market is the axis around which all the other markets revolve, because it has to do with money and as such is the most liquid of all markets. Currencies can be converted instantly. The flow is swiftly and immediate. As market sentiment changes, currency pairs change direction following risk sentiment, market news, or economic data. Every decision in the market, whether as an investor, speculator, government, bank, or institution, is about money. Risk and return is why the Forex market is the hub around which all the others rotate. Currency market is the most complex of the four asset classes, because central banks, governments, and politicians all manipulate their home currency in one way or another, either for economic or political reasons. The value of currencies is influenced by inflation, growth, and economic data. Governments use protectionist policies, market manipulation, and artificial stimuli. There are many ways to deal in currencies. A financial institution, for example a bank, wishing to sell the US dollar can do so against many other currencies. They can also use several mechanisms to achieve this. Currencies have different risk profiles from high to low. The Japanese yen and US dollar are examples of safe havens. Finally, the foreign exchange market is unregulated, which presents opportunities for dishonest players and problems for us as Forex traders. Let us summarize. Markets move on risk and sentiment, which result in the consequent flow of money from high-risk assets to low-risk assets. All markets are interconnected via a number of linkages. These linkages exist in all time frames and can be seen on every price chart used by traders, for example intraday scalpers, swing traders, and longer-term traders. The relational view is completed by the fundamental and technical views, which complete the picture and provides a holistic picture of all trades. Our next video, make sure to subscribe to our YouTube channel. We make difficult concepts understandable so that you can profit. Join our membership site at www.imalipro.com. You can join the free or paid section for invaluable trading information and techniques. In the next video, we will discuss the psychology of trading. You are the most important component of your trading setup.